If you're looking for a product that invests in British shares and aims to pay you some income as well as grow your money over time, then the Merchants Trust, a FTSE 250 listed investment trust, might just be for you. Today, I'm going to break down how exactly it goes about investing in the financial markets. Hi, I'm Marcus De Silva. I've been an investment and communications specialist in the investment industry for 15 years. Today, we're going to examine a financial product that's been investing in the financial markets for more than a century. It's the final video in our retirement series with Allianz Global Investors. Check out their playlist in the YouTube channel. There you will find lots of videos that aim to help you craft that dream retirement. Of course, if you like what you see, please subscribe to the channel and turn on notifications. Today, I'm going to be taking a deep dive into the Merchants Trust and explain exactly what it does for investors. It's mind-boggling to think, but these guys have been investing in the financial market since 1889, back in Victorian London, when it was the epicenter of global stock markets. I won't be discussing investment performance today. You can find that information wherever you buy your shares or on the Merchants website. Okay, let's start with what the trust is trying to do for its investors. The Merchants Trust is attempting three things. First, it aims to pay you a decent level of income. Now, this sounds a little vague, but if you're trying to estimate roughly what it might pay you, then a really useful figure to look at is its dividend yield. That's all the income that the trust has paid out over the past 12 months, expressed as a percentage of its current share price. Importantly, no one knows what merchants may pay in the future, but the board of the trust will be trying very hard not only to maintain what it pays each year, but to grow the income, which is in fact its second objective, to grow the income it pays you over time. Its third and final objective is to grow the original amount that you invested. This is referred to as capital growth. In summary, this is an investment product which targets both income and growth. The Merchants Trust focuses on buying the shares of larger, more established British companies that are listed on the London Stock Exchange. Importantly, it is looking for those that pay a decent dividend. This is when a company doles out some of its profits to its shareholders. But it's not the sole reason for investing though. The manager says primarily that he wants companies that are going to make money regardless of whether this is through the payment of dividends or from the share price increasing in value. Given the global multinational nature of many of these firms and their revenues, what's useful is that your investment won't just be tied to what's going on in the UK economy. The trust is also allowed to invest a small slug overseas, up to 10% of the portfolio. This is very normal. Investment products tend to have a little leeway in this regard. The trust fund manager is Simon Gurgle, a Cambridge-educated mathematician who started life in the city as a professional investor in 1987. He is part of the investment team at Allianz Global Investors, a big investment firm that invests hundreds of billions of euros for its clients. Simon wants to invest in companies that are both good at what they do and whose shares appear to be trading cheaply in the market. To find these, he'll be looking for three things. First, companies that are good quality. This means identifying characteristics such as whether it offers great products and services and beats the competition, if it's got decent growth prospects, whether its finances look strong and there's plenty of cash coming in, if its management's interests are aligned with that of the shareholders, and how it scores on things like its impact on the environment and society. Second, he'll be trying to find shares that look good value, which he will determine through various accounting metrics. And third, he'll look for any wider trends that may help drive the company's prospects in the future. For example, emerging digital trends that may help underpin ongoing demand of its products or services. Investment trusts are a unique product found only here in the UK. They're still diversified funds, so will spread your risk by investing in the shares of lots of different companies, but they also come with some unusual features. The three main ones are: number one, they can borrow money to make additional investments. You might hear this referred to as gearing, and this gives them extra firepower to capitalize on opportunities when they see them and enhance returns. But remember, this also acts as a double-edged sword and can exacerbate losses too. Number two, they have a revenue reserve, which is simply a pot for storing some of the dividends paid out by underlying companies. This is very useful because if there's a downturn in the business environment and certain portfolio companies need to reduce their dividends for a while to conserve cash, the trust can dip into its pot and top up the income paid out to investors. And number three, they have their own independent board of directors who will keep a critical eye on things and how well the fund manager is investing your money and hold your best interest as a shareholder at heart. This is an equity investment, meaning it invests in company shares. These are the riskier of the two main financial asset classes, the other being bonds. As such, it can be regarded as a medium-high risk investment. As with any equity investment, what the regulator says is that it's wise to take a long-term view because the value can go up or down and time can smooth out the ups and downs, hopefully reducing your chances of a loss overall. That said, the trust investments are in larger, more established firms, as opposed to smaller, riskier firms. There are also firms which are choosing to list in the UK, where we have a strong rule of law, a long history of doing business, and companies that tend to be well managed. Within the portfolio, it is diversified across sectors and has between 40 to 60 company holdings.